All right, welcome to the weekly roundup. I'm Scott, that's Ben, as usual, and
Hello.
it's what is it? April 6th, 2023. Let's just jump right in. Lots going on this week, including the ex-president finally going down. You want to start there?
Sure. He's going to use it as his launch pad for his next candidacy.
Yeah, you
Yeah,
figure it.
yeah. I mean, 34 charges. I'm gotta think it's not amazing for him. He did a speech yesterday after it. It was not great.
Mm.
I think Melania, his wife too, wasn't there. He didn't thank her, so I'm sure there's issues going on at home. I think it's probably bad for him in general, and we'll see what happens. But I don't know if DeSantis is any better. So
Yeah, yeah. It's because it's more of a media circus than anything by the sounds of it, by the looks of it. So
certainly,
certainly.
yeah.
All right, what else happened in the world of finance and the economy?
Well, lots. I think the most exciting research thing I had this week is Raoul's GMI came out. He always gives away his January think piece at the end of the first quarter for free, which is nice because the people that subscribe to this pay $50,000 a year to get his research and access. So it's nice to get a look inside how he's thinking, what the reason is, and his framework is macro based as well. So super interesting for me. So a bunch of the charts will be as a result of that. So we'll go through that. But in the world en masse, we've seen continued money piling into money market fund, which I've kind of talked about, I think, almost daily now in the dailies. Just money's coming out of the banks into money market because the banks are paying little and money market's paying 4x little. So as that money continues to come out of the financial system, it continues to put strain. And you know, this issue that 6 months ago was just a slowing economy. We've had early stages of a banking crisis, and the next point of this is, credit is at risk. So you've seen spreads, which is the bonds, corporate bonds, um, spread between government bonds is getting wider. And as they get wider, that shows that there's stress in the system, and so that has continued to evolve. And as financial conditions stay tight like they are right now, that it puts further pressure on some kind of credit event, which would be kind of the next leg of the type financial conditions we're seeing here.
Sure.
Yeah.
Okay, why don't you get the slides keyed up there? And of course, as usual, if there's any questions, just type them in hit the Q&A button at the bottom and type them in there. We'll get to them right away. Looks like you're in a new location there as you open the slides.
I
Secret
certainly am
secret location?
in the bunker.
The bunker, eh? After the
No,
ice storm?
my power was out, as you know.
Mm,
So I am in Bank Branch and working through it here. But yeah, no, busy day in here because a couple of the other bank branches, the power was out. So we had a full house today.
nice.
Yeah,
Great.
exciting. Lots going on.
All right. What do we got here on the screen?
Can you see it?
Yep.
All right. So this derivatives, nobody knew anything about derivatives until 2008. And it seems like it was kind of behind the scenes for a very long time. I think 2015, 2011, we had some worries about derivative exposure in Europe and a little talk about derivatives when Credit Suisse went down. And while this slide is probably skewed, I've tried to dig in and get a better understanding for what the net exposure is, but it's a look at the derivatives that exist in the system today. And so I've had ongoing questions about this from people. So I thought I'd put it up there because I saw this slide this week, which is total derivative exposure on US bank balance sheets they have at $193 trillion. So it's obviously a pretty big number. But I've been trying to dig in to better understand what the net exposure is, how much of this is hedged, how much is not. But really, the bigger this number becomes, the more fragile these banking institutions become. So Goldman, JP Citi, those of course would be the biggest banks in the United States. So, as we start to get cracks in the system, this is when you'd see things start to perk up. So it's a big number and requires kind of further investigation to understand what the overall net exposure is, but something to be cautious of.
Okay.
So now we'll jump into just, these are all GMI slides. Some of these I may have said or talked about before, but GMI does kind of many different views, but everything's macro based. So if we look at this here, these green lines are recessions. So 1980 and until today. And so as we see these green lines, these are the recession periods that we go through. And what happens, or at least historically, what's happens prior to this recession is they have GMI has an economic sentiment indicator. So this is a forward guidance indicator to see what they see coming ahead. And so as we look coming into the start of this year, the sentiment indicator was deeply into the negative. Well, I think we will, as I've been saying before, look back and say that Q1 was the early stages of a recession. I think we'll probably see a green line here, and this is really more of a, this is where we are, this is what the sentiment is, and in the early stages of recession, and we'll continue to see that playing out, at least so far. Another couple of slides around this as well. Again, this comes from GMI. And so we look at this ISM price pressure composite. And so they use a 5-month lead. So they look at the backwards looking data, and then with the data they have, they provide kind of a lead guidance of, ultimately as an investor, you're always trying to position for what's coming in front of you. So what Raoul and team has built is what's coming in front of you. And so with their lead indicator, ISM pressure they have right here, and this number here on the left-hand side, which is a 50, anytime you drop below 50, it tends to mean that the economy is contracting. Above 50, the economy is expanding. And so if you overlay this with the blue, which is US CPI year over year, these tend to track each other. You can stretch this chart back even farther, but they tend to track each other. And so if you look at this, this is pointing towards inflation decelerating extremely quickly. And if they do match up, that gets you somewhere close to zero-ish. And Raoul's view is actually we get deflation, at least temporarily. And another piece here we look at, which is, again, US CPI is the white, is the left-hand side here. So this is the white line where it looks like we peaked in October of last year, just north of, just around 9%. And then if we look at the average of 5 major year-on-year outbursts of inflation, so we look at what that means. When we get a big surge of inflation since the 40s to 80s, what tends to happen on the other side of that, and these are monthly numbers along the bottom. And so what tends to happen on the other side of that is we get a pretty material deceleration of inflation, ultimately results in probably coming back to their long-term trend lines. And so that really differs from what the general narrative is today. And if you're positioned for this, then you got to think about what that means for stocks and bonds, and I'll provide some comments on that as we get to the end. Then we think about market sentiment. And so this is US equity put call ratio. And what does this mean? Ultimately is that the market has extreme exposure to puts. And so when you get, again, tilted heavily towards one side, everyone's fearful that the market's going to fall. And what happens is you get over tilting to one side. And then when this reverses, you get a big rally in stocks. And so some of this has already happened because we had a pretty material rally in January, February, and given some of that back now. But the positioning still extremely bearish, and that tends to kind of skew towards one positioning and presents really opportunities for the markets. So the last two pieces that I'll comment on is just really more of a long-term thinking and positioning. And so, as most of you know, I have a view on certain areas, and I do think that that blockchain and technology, some of these technology companies can do extremely well longer term. And I think there's a unique opportunity set here. But if you look at what the general media has been talking just about the Nasdaq and the any of the so ARKK, which is ARK, everyone's kind of pushing them to the side that this technology is dead, it's never going to work, blockchain's never going to work. This is, I think, something where we can take a look back and say what's happened in similar periods. And so if we look on the right-hand side here, this is the NASDAQ index from 1996 to 2004. So we saw a massive run up into 99, 2000, which I remember early in my career. Then we saw a basing period, which took a little while. And then if we take a look at another chart, this is ARKK over the past couple of years as well. So a similar time set, 2018 to 2023. So a big, obviously, run up as there's the crypto and blockchain craze, following by a pretty significant sell-off, and we're into kind of this basing period. And so when these types of things happen, you think, okay, is this technology done and not worthwhile, or should we look at this as an opportunity longer term? And so if we fast forward, to where we are today, and think about how this played out. If you look, this is the blip that I just showed you on the previous slide, and then you see a kind of a multiple X up to where we are today. And so, if we stretch it back longer term, I think this is a long-term really great opportunity for entries. And some of the things that I did last year, if we look, where I started to buy Facebook and Meta over the back half of last year, and that's done quite well through here. Some of these things we're thinking about, we're trying to look where's the trajectory of the market going to be long term. And sometimes it's hard to do that when you're in the chop and the daily grind of what's happening in the markets and portfolios. And I think sometimes it's important to stretch it back and say, what does this look like from a longer term perspective, and where's the potential opportunities that we're seeing in this unrest that the market's presenting to us today. I think that's it. That's all I got on the chart front today.
Nice, well paced. Hey, you didn't rip through them. We could actually understand it. It was great. Loved it.
Yeah,
loved it. We actually have a pretty good question here from Lyle.
Okay.
Who or what is GMI?
Oh, it's a global macro investor. That's the name of Raoul Pal's macro research house. And so he has a following of institutions and hedge funds and high net worth families that work with him. He only opens up the subscription once in a while, but people pay $50,000 a year to have access to his think pieces and investment recommendations.
Amazing.
Yep.
All right. Well, let's look ahead to, I guess it's it's a short week this week in the markets. Are the markets open on Monday?
Short day on Monday. Yeah.
Short day on Monday.
Yeah.
What does that mean?
So,
open till when?
I think till 1 on Monday.
Gotcha.
Yeah.
Okay.
Markets will be pretty quiet though.
Yeah, exactly. Yep. All right. So typically coming off a long weekend like that, mega holiday, what are we anticipating to see in the markets next week?
So I think more of the same. It's this battle of what's happening in the economy. Tomorrow is interesting. Just from the perspective is the markets are closed in Canada and the US. But the US is issuing their non-farm payrolls tomorrow number, which the jobs numbers this week were pretty weak in the US. And this is the first time that I can actually ever remember that a data set comes out on a holiday. So that could have an impact with what happens on Monday.
Sure.
But it's more of the same. I think the numbers are starting to show what we've been talking about for a while, is that the jobless numbers are increasing. And so as a result of that, it kind of takes some of the pressure off the central banks. And so at least the bond market has been telling us that they start to agree with that. And so bonds have rallied, like the US 10-year bond has hit a new kind of low level. And so we've seen bonds rally. And so I'm continuing to be watchful of that. You know, I think one of the risks that I have right now is just saying, you know, like when do we pivot? When do we take our profits from how that trades work, and when do we start to shift a little bit more aggressively? And so I'd be playing with that right now and just saying, you know, when does this kind of run its course? Because I still think yields go significantly lower. Because I said, like on the call last week, the positioning is still short bonds. And until we see that flip from short bonds to long bonds, we'll stay with it. So I'd continually be watching the positioning on the bond side before we switch from a little bit more defensive to a little bit more aggressive, which is what I'm looking for.
Makes sense. Okay, last call for any more questions. Any parting notes?
Nope. I guess the last one would be just really tax. And so if you need something and you don't have it, let us know, because we've sent out quite a bit of information, gains, loss, foreign properties, tax packages, you know, T-slips. If there's anything that you need that you don't have, let us know. But we sent out quite a bit of information here, and last week and this week we have, and if there's more to come next week, certainly please let us know.
Yeah. And as you've been mentioning too, just to mention again, the way it works now too is that CRA actually has all those slips too, so your accountants, or you can pull it down right from CRA as well. So if there's anything missing off our online system or something we can't find, you can, you or your accountant can certainly find it on your online CRA account as well. Correct?
Yep.
Okay.
Correct.
Perfect.
Yep.
All right, everyone. So for everybody that celebrates it, happy Easter, and I believe it's Passover too, and all the things.
That's it.
Okay.
Excellent.
All right, everybody. Have a great long weekend, and we'll see you next week.
Thanks. Sounds good. Thanks. Take care.
Bye.